On Monday, December 29th, 2025, silver did something it almost never does in polite company. It sprinted upward like a rumor turning into fact, pushed into the low to mid-80s, and then, without warning, fell through the floor into the mid-70s, fast enough to make a screen feel dishonest. If you were asleep, you woke up to a chart that looked like an accident report. If you were awake, you felt that particular kind of nausea that only happens when a market stops behaving like a market and starts behaving like a trap. And here's the part that matters. This wasn't just a silver story. It was a story about plumbing, about leverage, about mechanical flows that don't care what you believe, about how modern markets can turn a hard asset, an element on the periodic table, into a fragile chain of obligations that can snap at the worst possible hour, in the thinnest possible liquidity, when almost nobody is watching. That's not normal. Silver is supposed to be boring. It's supposed to drift and grind. A metal you remember exists when someone mentions jewelry, solar panels, or old coins in a drawer. But in 2025, silver stopped being sleepy. It started acting like a fire alarm, and the world treated it the way the world always treats an alarm. Ignore it until it gets loud enough to wake you. So let me walk you through what happened, what the headlines missed, and why the phrase index rebalancing sounds harmless, but can be the match that lights the room. Because when silver whipsaws like that, it isn't just volatility. It's a stress test. And what got tested on December 29th was not your patience. It was the structure of the paper market itself. For a moment, go back with me to the last week of the year. This is the week where calendars lie. The news cycle slows down, offices half close, liquidity thins, and the financial world runs on skeleton crews and automated systems. People call it the holiday week. Traders have another name for it, the week where the order book is more rumor than reality. In that kind of environment, price doesn't move like it does in March or October, when everyone is at their desk, and every quote has depth behind it. In late December, price can move because somebody wants out, or because somebody is forced out, or because a model recalculates risk and decides, in cold arithmetic, that the position you were comfortably holding an hour ago is suddenly unacceptable. And that's where the story starts to get uncomfortable. Because if you want to understand a move like this, you have to stop thinking like a human and start thinking like a machine. Machines don't panic. Machines don't take profits because they got nervous. Machines follow rules, maintenance margin thresholds, volatility triggers, index weights, risk budgets, collateral constraints. And when those rules collide with thin liquidity, the move can look like madness, even though it's actually logic. The move on December 29th had that signature. A surge into the 80s, then a slump into the 70s. Some observers described it as one of the sharpest drops in years. Others focused on the sheer speed from the intraday high to the low. You can argue about the exact percentage depending on which anchor you use, high to low, close to close, but you can't argue about the feel of it. It felt like the market hit something invisible, and when a market hits something invisible, you look for invisible forces. One of those forces was hiding in plain sight, margin. Most people hear margin and think of retail day traders, someone clicking buttons on a phone, borrowing money to buy a stock. That's the small, noisy version of the word. The quiet, powerful version lives in futures markets, where margin is not an optional tool. It's the mechanism that keeps the entire system from defaulting every afternoon. Futures are a promise, a contract, a bet. You don't pay the full value up front. You post a performance bond, margin, and you mark to market. Gains and losses settle daily, sometimes intraday. It's elegant when volatility is normal. When volatility is not normal, margin becomes the lever that turns pressure into forced selling. Because when the exchange raises margin requirements, it's effectively saying, the world is more dangerous than it was yesterday, so you need more cash to hold the same position. If you have the cash, you wire it. If you don't, you reduce risk. And if you're leveraged and the move goes against you, you don't get to negotiate with the market. You get liquidated. That isn't drama. That is structure. On that day, the silver market was dealing with exactly that kind of structural pressure. The exchange's clearing side raised margin requirements for certain metals effective December 29th. That matters because margin changes are not commentary. They are constraint. They ripple outward through brokers, funds, and risk systems. They can force position reductions even if your thesis hasn't changed by 1 inch. Let that sink in. A person can be right about the long-term direction of silver and still get blown out in the short term because the system decides they can afford to keep holding the risk. That's not a judgment on the metal. It's a judgment on the balance sheet. And balance sheets in late 2025 were not exactly relaxed. 2025 had been an historic year for gains in parts of the precious metals complex, and silver had started to behave less like an industrial input and more like a monetary signal. It was moving fast enough to drag in trend followers, systematic funds, and anyone who had been waiting for the metal to finally wake up. When that happens, the market fills with people who are long for different reasons. Some are long because they want metal exposure. Some are long because their models read momentum as positive. Some are long because they're hedging something else. Some are long because they're running a portfolio that is, in reality, a web of offsets and correlations. But here's the catch. When a move turns violent, all those reasons converge into one instruction: reduce risk. And that instruction doesn't arrive in a soothing tone. It arrives as a margin call, as a VAR recalculation, as a dealer hedging shift, as an index fund rebalancing flow. So yes, profit taking is always part of the story. People do sell after a huge run. That's human nature. But on days like this, the bigger driver is mechanical. Because profit taking sells at a price. Forced selling sells at any price. And that's the difference between a normal pullback and a market that falls like an elevator. If you want to see how ugly forced selling can get, you don't have to imagine. You can study history. Step back with me to 1980. Silver rocketed in the late 70s, fueled by inflation fears and the famous attempt by the Hunt brothers to corner the market. The details are complicated, but the ending is simple. Margin rules changed, liquidity tightened. The system decided the trade was too large and too dangerous, and silver collapsed. In that episode, too, the story was not silver suddenly became worthless. The story was that leverage collided with rule changes, and the market discovered the limit of the structure supporting it. Fast forward to 2011, silver surged toward $50. The narrative was a mix of monetary debasement fears, post-crisis distrust, and speculative fever. Then, again, margin requirements were raised. Multiple times, the market cracked, the metal fell hard. People who believed were forced to sell anyway, not because belief changed, but because the margin did. Different decade, same costume. That's why I don't treat December 29th, 2025 as an isolated event. I treat it as a rhyme in a longer poem. Silver becomes volatile, leverage builds, rule sets tighten, liquidity thins, and the move becomes a cascade. Now, the cascade is only half the story. The other half was happening in the background, where most people never look, the money markets. I'm going to say a phrase that sounds boring, but you have to stay with me: the repo market. Repo is the engine room of modern finance. It's the place where institutions borrow cash overnight against high-quality collateral, usually treasuries. It's how dealers fund inventory. It's how they smooth daily needs. When repo is calm, the system breathes easily. When repo is stressed, the system gets tight in the chest. Around that time, there was a notable draw on a central bank liquidity backstop, roughly $26 billion through a standing repo facility. That did not mean anyone bought silver. It did not mean a secret rescue of the metal's price. It meant something more subtle and more important. Someone, somewhere, wanted cash against collateral, and they wanted it urgently enough to use the backstop. That is a signal, not of a silver bailout, but of stress in the broader funding environment at the same moment volatility was spiking and margin requirements were tightening. If you are a dealer making markets or a bank intermediating risk, you don't just think about price, you think about funding, you think about collateral, you think about whether your counterparties will be able to meet calls. Because here's the brutal math of derivatives. For every long contract, there is a short contract. For every winner, a loser. The exchange's clearinghouse sits in the middle and guarantees performance of both sides, but it does so by managing margin, risk, and default resources. In a normal day, this is almost invisible. In a violent day, the clearing process becomes the main event. If someone can't meet margin calls, positions are closed, losses are crystallized, liquidity is demanded. And that demand doesn't just hit silver. It hits cash markets, it hits funding markets, it hits whatever assets can be sold quickly to raise cash. This is where the story stops being about a metal and starts being about a regime. We are living in a world where finance is so interconnected that a violent move in a comparatively small market can cause a tremor in the funding ecosystem. Not because silver is systemically important in the way treasuries are, but because leverage is systemic, and leverage doesn't respect asset class boundaries. The system doesn't like that. Now, let's talk about something else that was quietly sitting on the calendar: index rebalancing. At first glance, index rebalancing sounds like housekeeping, like dusting a shelf, adjusting a spreadsheet. Nothing dramatic. In reality, index rebalancing is a scheduled wave of forced transactions. Commodity indices, major benchmarks that funds track, set target weights for different commodities. Those weights can change year to year based on rules, production, liquidity, volume, and methodology constraints. When weights change, the funds that replicate those indices must adjust their holdings. They don't have the luxury of saying, "I'll wait for a better price." They are paid to track the index. Tracking requires trading. The trading is not optional. If silver's weight rises or falls in a major commodity index, billions in benchmarked assets must buy or sell futures to match the new target. Even if the weight change is small, the notional flows can be meaningful because the market itself is not infinitely deep. And in late December and early January, those flows don't arrive in a perfectly liquid environment. They arrive during roll periods, holiday staffing, and the kind of thin order books that can turn a normal rebalance into a shove. So when analysts warned that index rebalancing could lead to more wild swings, they weren't being poetic. They were describing a real risk, mechanical flows from large, rule-bound portfolios hitting a market that was already on edge. This is how you get volatility that feels detached from reality, because it is detached from narrative, from fundamentals, from the human impulse to wait. It's arithmetic. Now, if this were only a paper market story, it would still matter. But the reason silver captures imagination is that it lives in both worlds. It is a futures contract and a bar in a vault. It is a line on a screen and an input into solar panels. It is a speculative trade and a strategic material. And in late 2025, the gap between those worlds began to show. One of the most revealing details around this episode was not the candle on a Western chart. It was the persistent premium in parts of Asia relative to Western reference points. Regional premiums can appear and disappear. Logistics, taxes, and local demand can do that. But what stood out was the magnitude. A spread measured not in pennies, but in dollars. When you see that kind of gap, the obvious question is, why isn't arbitrage closing it? In a textbook, it should. Buy where it's cheap, sell where it's expensive, pocket the difference. Do that enough and the gap collapses. In the real world, the metal is not a frictionless token. It has to move, and movement has constraints. Licensing regimes, export controls, capital restrictions, local taxation, delivery specifications, shipping capacity, counterparty willingness, and the simple question of whether the metal you can buy in one market is the metal you can deliver in another. And late 2025 was not a frictionless world. There were policy shifts around export licensing that introduced additional barriers and uncertainty. Even the prospect of added friction can widen spreads, because arbitrage is not just math, it's execution risk. If you can't guarantee you can move the physical metal when you need it, the arbitrage isn't a free lunch. It's a potential bankruptcy. So you had a world where paper prices could swing violently in the West, while the physical demand story in the East remained firm enough to keep premiums elevated. That tells you something important. Not the West is fake and the East is real in some simplistic sense. Markets are complex. Both sides contain truth and distortion. But it does tell you that paper markets can overshoot, downward as well as upward. Because paper is traded on balance sheets and risk models, physical is traded on need. Need is slower, but it's stubborn. And when paper and physical diverge sharply, the stress doesn't disappear. It migrates. Sometimes it migrates into inventories. Now, inventories are another place people like to overdramatize, so let's be precise. COMEX inventory numbers include metal in different categories. Some is registered, available for delivery against futures. Some is eligible, meeting standards but not committed. The total number can look enormous, hundreds of millions of ounces, and yet what matters for deliverability and tightness can be a smaller slice. When you see notable withdrawals from specific vaults, hundreds of thousands of ounces in a day, it doesn't to you must automatically mean default tomorrow. But it does mean someone is taking metal out of the system, out of the pool of readily mobilized inventory, and into private possession or into industrial use. And timing matters. If you see physical metal leaving vaults while paper prices are getting punched lower, you have a clue that different participants are responding to different signals. Paper traders respond to volatility and margin. Physical buyers respond to opportunity and fear of future scarcity. This split personality is what makes silver dangerous and fascinating, because it means you can have a day where the price action tells you panic, while physical flows whisper accumulation. So what were we really watching on December 29th? We were watching a market that had gotten extended, that was entering a calendar window known for thin liquidity, that faced raised margin requirements, and that was staring down the barrel of systematic flows tied to year-end and early-year index mechanics. In that cocktail, it doesn't take a conspiracy. It takes one missized position, one fund that was long too much and funded too aggressively, one dealer that had to hedge into a falling market, one systematic program that flipped from buy to sell because volatility changed the regime. Then the dominoes do what dominoes do. That's why I'm careful with the word cause here. Markets don't usually have single causes, especially not modern ones. They have catalysts, amplifiers, and feedback loops. Margin changes are catalysts. Thin liquidity is an amplifier. Dealer hedging can become a feedback loop. Index rebalancing is a scheduled flow that can act as both catalyst and amplifier depending on timing. Funding stress in repo is an indicator that the system is tightening. Put those together, and you get a move that looks irrational until you realize it is the rational outcome of interacting constraints. Now, let S address a seductive narrative that always shows up after a crash. The idea that it was all retail. It's a convenient scapegoat. It suggests the big institutions are in control and the volatility is caused by amateurs who done it to know what they were doing. Sometimes retail contributes to froth, no question. But think about the clock. Most ordinary holders of silver are not dumping thousands of futures contracts in the dead of night. They're not managing gamma exposure. They're not adjusting to index weights on schedule. Their actions are slower. They buy bars, coins, and ETFs. They add over weeks and months. They don't usually create a vertical drop in minutes. The more plausible driver of a violent, fast move in futures is institutional behavior, even if that behavior isn't a person deciding to press a red button. It's institutional systems, risk engines, margining responses, systematic rebalancing, hedging programs, doing what they are designed to do. Here's where it gets interesting. The same structure that can smash price down can also set up a violent rebound, because once forced selling is done, once the weak balance sheets have been flushed, once the margin shock has been absorbed, once liquidity returns, price can snap back with equal brutality. This is why silver is a cruel teacher. It punishes both complacency and overconfidence. Now, does that mean a rebound is guaranteed? No. This isn't a fairy tale where the metal must return to some true value by Friday. Markets can stay distorted longer than you expect. But I can tell you this. The ingredients that create overshoots don't vanish overnight. They often create a second and third wave. And that is where index rebalancing returns to the center of the frame. As institutional desks come back from the holidays, as roll periods mature, and as benchmarked funds execute required adjustments, you can see additional bursts of volume hit the tape. Volume that is indifferent to narrative, indifferent to feelings, and often indifferent even to fundamentals in the way most people use that word. If silver's weight in major commodity indices shifts, and if those shifts land inside thin liquidity pockets, you can get sudden moves that feel unreasonable. Not because someone is targeting the market, because the market is being moved by obligations. Think of it like this. If you own a home and a storm hits, the wind doesn't care about your mortgage rate. It cares about the structure of the roof. If the roof is sound, you ride it out. If the roof is weak, it peels off. December 29th was a gust. It didn't tell us everything about silver's long-term destiny, but it told us something uncomfortably specific about the roof. The paper market, S behavior, can become fragile when leverage, margin, and mechanical flows stack on top of each other. That fragility matters for everyone, not just traders. Because in a world of persistent deficits, heavy debt burdens, and geopolitical fragmentation, hard assets don't just trade on supply and demand. They trade on trust, on the credibility of the monetary regime, and silver lives right at that intersection. For a moment, go back with me to periods when money itself was questioned. In inflationary decades, people reach for hard assets as a kind of moral protest. Gold is the classic, but silver has always been the restless cousin. More volatile, more accessible, more tied to industry, and therefore more sensitive to cycles. When trust in paper claims erodes, silver can move not just because factories need it, but because people want something that cannot be printed. But here's the uncomfortable twist. Modern finance has found ways to create paper claims on hard assets that are vastly larger than the physical market beneath them. Futures, options, OTC derivatives, unallocated accounts, synthetic exposures. These layers allow enormous notional bets on silver without moving a single bar. That's convenient until it isn't, because when a paper market grows large relative to the physical float, price discovery becomes dominated by paper flows. And paper flows are dominated by balance sheets, margin rules, and funding conditions. That's why repo matters. That's why margin notices matter. That's why index rebalancing matters. They are not side stories. They are levers that move price when the system is under pressure. Now, let me make this personal, because if you're listening to a long explanation like this, you're not here for trivia. You're here because you care what this means for you. It means the era of calm, well-behaved commodities is not guaranteed. It means you can be right about the macro story, about debasement, about industrial demand, about supply constraints, and still get whipsawed if you approach these markets with too much leverage or too little respect for structure. It means risk management isn't an optional accessory. It's the cost of admission. And it means that when you see a violent move in silver, you should ask different questions than most people ask. Not what headline caused this, but what rule changed? What constraint tightened? Who needed liquidity? What mechanical flows were scheduled? Where did the stress show up? In margin, in repo, in spreads, in inventories? Because those questions lead you to signal. Headlines lead you to noise. This isn't a prediction, it's arithmetic. If volatility rises, margin rises. If margin rises, leveraged positions become more expensive. If positions become more expensive, some holders must reduce. If reduction happens in thin liquidity, price falls more than it should. If price falls quickly, risk models tighten further. Dealers hedge more aggressively. Systematic funds adjust. The loop feeds itself. That is the modern market in one breath. And silver, on December 29th, performed it in real time. So where do we go from here? We have a few plausible paths, and none of them are nothing happens. One path is stabilization. Liquidity returns in early January. forced selling is largely behind us, and silver begins to rebuild, perhaps even violently, as shorts cover and longs re-enter with fresh capital. In this path, late December becomes a scar and a lesson, not a regime shift. Another path is chop. The market remains unstable because the same mechanical forces that helped create the move are still active. Index-related flows continue. Margin remains elevated. Funding conditions stay tight. Silver becomes a battleground, swinging wider than most investors are emotionally prepared to endure. A third path is darker. The volatility in silver is a symptom of broader funding stress, and the real story is not the metal but the system's sensitivity to leverage. In this path, silver is not the cause of anything, it is the canary. It sings when the air quality in the mine starts to deteriorate. Which path is most likely? I don't pretend to know with certainty, but I know what to watch. Watch how margin policy evolves after the shock. If requirements stay high, it tells you the system expects turbulence, and turbulence forces cautious positioning. Watch funding signals, repo usage, spreads, the behavior of short-term rates. When money markets are calm, dealers make markets. When money markets are stressed, dealers protect themselves, and liquidity disappears exactly when you need it most. Watch physical premiums and regional spreads, not because one market is true and another is fake, but because persistent divergence tells you about friction, constraint, and demand that cannot be satisfied instantly by paper claims. Watch inventories, but don't romanticize single-day moves. Look for trend. Look for categories that matter for delivery. Look for whether withdrawals persist. And watch the calendar for mechanical flows, roll periods, benchmark reweights, the return of institutional desks. Markets often move hardest when human narratives are quiet and mechanical obligations are loud. Now, I want to end this the way I began, with the idea that what you saw was a stress test. Silver didn't just go up and down. It exposed fault lines. It exposed how quickly confidence can evaporate when liquidity is thin. It exposed how margin can turn a normal adjustment into a cascade. It exposed how index tracking and systematic mandates can move markets regardless of story. It exposed that the financial ecosystem is still, even after everything we've lived through in recent decades, deeply sensitive to leverage and funding. And once you see that, you can't unsee it. The temptation after a day like December 29th is to look for villains or comfort, to say it was manipulation, or it was retail panic, or it was some single headline you missed. Those explanations are emotionally satisfying because they make the world feel simple. But the world isn't simple anymore. It is layered. It is engineered. It is full of quiet decisions, margin changes, index weights, collateral rules that can move more money than 1,000 speeches. So the question for you isn't, what should I buy or sell tomorrow? The question is, do you understand the landscape you're walking through? Because if you treat this landscape like a calm decade of low volatility and predictable policy, you will keep getting surprised. If you treat it like a late cycle environment where the ice cracks underfoot, where liquidity can vanish, and mechanical flows can stomp through thin markets, then you will stop confusing noise for signal, and you will start behaving like someone who has seen a few cycles. Whether you end up holding silver, trading it, avoiding it, or simply using it as a gauge, the lesson is the same. The system reveals itself in moments of stress. December 29th was one of those moments. Most people will file it away as a weird day on a chart. Don't. Notice what it was really saying, because the next time the market moves like that, it won't ask whether you were ready.